Welcome everyone to this explainer. Okay, let's dive into this. When you look at the world's absolute richest people, there is this massive, fascinating anomaly staring right back at us. Warren Buffett. I mean, he didn't build his fortune by coding some disruptive app in a garage, or launching a crazy crypto coin, or day trading from a multi-monitor setup. No way. His reality is actually way quieter than that. He built his massive empire by reading, waiting, buying incredibly boring businesses, and doing literally almost nothing for really long stretches of time. So let's strip away all the modern hype and uncover the actual blueprint of his wealth.
Just think about the sheer contrast in mindsets here. On one side, we've got the average mindset. The modern hustle culture that's constantly pushed on us, chasing the latest crypto trend, day trading, demanding constant action, fast money. But contrast that with the Buffett mindset, and it's a total 180. We're talking about reading financial reports, waiting patiently, investing in remarkably boring businesses, and just letting wealth accumulate slowly. We are so wired to think success means frantic action, right? But Buffett proves the ultimate investment secret isn't a genius IQ or timing the market perfectly. It's patience. And the absolute best part? Anyone can copy the principle, even if copying the discipline is a whole lot harder.
Section 1. The Anti-Hype Billionaire. Let's look at his childhood lessons in cash flow.
You see, Warren Buffett was obsessed with money right from the get-go in Omaha, Nebraska, but not in a flashy, show-off kind of way. He was deeply obsessed with the actual mechanics of how money works. As a kid, he was out there selling chewing gum, Coca-Cola bottles, newspapers. He and a buddy even bought used pinball machines and put them in local barber shops just to see the cash flow. So the crucial point is, he learned really early on that the big money is not made by constantly buying and selling. And he learned this the hard way through a pretty stressful mistake with his very first stock. It was a company called City Service. Shortly after he bought it, the price dropped. He panicked a bit, like we all probably would, and when it finally climbed back up, he immediately sold it just to lock in a tiny profit. But wouldn't you know it, after he sold, that stock just kept going up and up. He realized he'd left a massive fortune on the table. It taught him that while beginners jump from trend to trend out of pure nerves, the stock market is essentially a giant machine designed to transfer money from the impatient to the patient. So, hold on to valuable assets. That's the real secret.
Moving on to Section 2, the Berkshire Hathaway mistake, proving that cheap doesn't always mean good.
Now, to really understand how Buffett's philosophy evolved, we've got to look at his mentor, Benjamin Graham, the legendary father of value investing. Graham taught him this brilliantly simple idea: do not buy stocks like lottery tickets, buy them like pieces of a business. Think about it like this. Imagine you're looking to buy a small shop right in your own neighborhood. You wouldn't just buy it blind, right? No way. You'd investigate the whole shebang. You'd ask how much cash it actually makes, if it's drowning in debt, if the owner's honest, if the customers actually come back. But when people buy stocks on a screen, all that common sense just goes right out the window. They literally just stare at a chart and ask, hey, is the line going up? Graham anchored Buffett to reality. Investigate the actual business and buy good assets for less than they're worth.
But, even with that incredible foundation, Buffett still stumbled badly. Because a bad business can stay bad for a really long time. Back in the 1960s, keeping Graham's lessons about buying cheap assets in mind, Buffett started scooping up shares of a struggling, declining textile business with these old, outdated factories. That business? Yep, it was called Berkshire Hathaway. He bought it simply because the stock price looked like an absolute bargain. He eventually took control of the company in 1965, but later confessed it was one of the single worst investments he ever made. He learned the hard way that a weak business and a dying industry, even if you buy it at a rock-bottom price, can just quietly destroy your capital over time.
And that painful lesson led to the most important pivot of his entire career. He shifted away from buying average businesses at bargain prices and totally upgraded his thinking to great businesses at fair prices. Now, this massive philosophical upgrade was heavily influenced by Charlie Munger, his longtime brilliant business partner. Munger basically pushed him to stop digging for cheap, struggling companies and instead hunt for exceptional quality. We're talking durable brands, serious pricing power, and intensely loyal customers. And that's exactly why Buffett eventually bought into legendary companies like Coca-Cola, See's Candies, American Express, and Apple. He stopped trying to guess what a stock would do next Tuesday and started asking, will this company still matter 30 years from now? He shifted to playing the forever game.
All right, Section 3, the ultimate compounding engine. Let's look at how time does the heavy lifting.
To truly grasp how Buffett amassed such astronomical wealth, you really have to understand this one single, incredibly powerful concept: float. Float is basically the money an insurance company collects in premiums today and holds on to before having to pay out claims later. And a massive part of Berkshire Hathaway's secret advantage comes directly from owning insurance companies.
And this brilliantly illustrates how this compounding machine actually operates in the real world. Step 1. You collect premiums from millions of customers today. Step 2. You securely hold that massive pool of money. That's the float. Step 3. And here's the absolute magic. Buffett gets to invest that float. Step 4. Eventually you pay out the claims much, much later. As long as that insurance business is run carefully and stays profitable, Buffett has virtually endless, continuous fuel to invest in other businesses and stocks. He didn't get rich off one lucky genius trade. He built a flawless mechanical system where money works, profits are constantly reinvested, and the machine literally never stops churning.
Which ties perfectly into Buffett's famous snowball analogy. Start early, keep going, find a very long hill. Compounding is kind of deceptive, right? Because it looks incredibly boring in the beginning. You invest and, well, nothing crazy happens. You invest again, still nothing. But over the decades, the growth actually starts feeding on itself. Money earns money, and then that new money earns even more money. The snowball starts out tiny, but if you just keep pushing it down a very long hill, it becomes a total, unstoppable avalanche. That is exactly why a massive portion of his wealth came much, much later in his life. Time is the ultimate secret ingredient here.
Section 4. 5 Rules for Wealth. Turning all this theory into practice.
Now, what's really interesting about this slide is how simple these rules actually are when you put them into practice. Rule 1. Buy assets, not hype. Don't chase whatever is trending on social media this week. You want to look for real profits and real value. Rule 2. Understand what you own. Simply put, if you cannot clearly explain how a company makes money, you probably shouldn't own its stock. Rule 3. Think long-term. You buy because the business is going to grow over years, not because the stock might pop tomorrow morning. Rule 4. Avoid unnecessary mistakes. Keep in mind, the real risk isn't a stock's volatility. The real risk is permanently losing your hard-earned money. And finally, Rule 5. Be patient. Now, this sounds super easy, but it's excruciatingly hard for most people, mostly because patience feels exactly like doing absolutely nothing. But trust me, when it comes to investing, doing nothing is an absolute superpower.
And that brings us to Section 5, the power of boring, why behavior actually beats intelligence.
Look, you and I might not have billions of dollars sitting around to buy an insurance company, but we can entirely copy the mindset. The average person is frantic. They want fast money, they demand constant action, and they are always out there searching for that one secret, magical opportunity. But the owner simply waits. They buy obvious, robust businesses or just diversified investments, and they calmly hold them for decades. They actively choose to spend less than they earn, they invest consistently, and they steer clear of highly emotional financial decisions. The uncomfortable truth of this entire explainer is that building wealth is not actually all that complicated. It's just remarkably hard because it requires you to remain totally consistent precisely when nothing exciting is happening. The boring path is, undeniably, the most powerful path.
So to wrap up our time together, I really want to leave you with a stark, challenging question. Are you building wealth like a trader, constantly chasing the next exciting move? Or are you building wealth like an owner, patiently setting up the next decade of your life? That choice ultimately dictates your financial future. Thank you so much for joining me on this explainer. Keep learning, keep pushing that snowball, and I'll see you next time.